Hey there. Welcome to another edition of Road Noise with Hutch, the Hutch Money Minute series. Today, we're going to talk about direct versus non-direct recognition. This has to do specifically with borrowing against cash value for the infinite banking concept. My little mnemonic device, we're going to explain what it means. You just add the word effect after the word direct. So a non-direct recognition policy will have no effect on your dividend, whether you borrow or not. Everybody gets the same dividends. There is a myth in the infinite banking community that this is not only better, but it's imperative. I will go out on a limb and say it's absolutely not true. In fact, I actually think the other way. There's a couple other infinite bankers that are kind of neutral. I'm not neutral. I'm going to go out on a limb and say direct recognition is better, and I'll tell you why, and I'll prove it. Direct recognition. So there is a direct effect on your dividend on loan money. So what that means is if you have $100,000 in cash value and you take a $70,000 loan, the dividends you get on the $70,000 of cash value that is being used as collateral for the policy loan, that will receive a different dividend than the $30,000 that is not encumbered by a loan. Now, it's often erroneously thought that it's always a penalty or a punishment, and it's actually not true. The dividend on the direct recognition dividend on the 70K of loan money could be higher or lower than the dividend on the 30K of the loan money. And I'm saying the dividend rate, like obviously as a volume, so 170, 130, but I'm saying the dividend rate. And here's what it depends on. So with direct recognition, if the policy loan rate is above the dividend rate, well, like it was in 2024, it will actually pull your dividend up to where when you're borrowing, you're paying a policy loan rate that is above the dividend rate. And so you would essentially be being punished because when you pay that policy interest, it goes back into the general account of the policy. You're not paying of the company. You're not paying yourself interest. And so to treat you fairly, since you're paying kind of an above market rate and you're basically subsidizing investment dollars in the portfolio with an above market dividend rate, well, they're going to subsidize you by lifting your dividend. Conversely, if you're getting some kind of sweetheart loan, you're getting a below market loan, which with several companies, that is actually happening now in 2025, where the loan rate is lower than the dividend rate. Well, then with direct recognition, they will pull your dividend down, right, on that loan money. Now, again, people hear that and they're like, I don't want that. Well, let's think about a couple things. Just let's put on our critical thinking hat and let's think about what's going on here. One is, intuitively, there's no free lunch, right? And so if you have a non-direct recognition policy and you're getting a loan rate, a sweetheart loan rate that's below the dividend rate, well, essentially all the non-borrowers of the whole life company are subsidizing, right? Now, I realize that a lot of people are like, oh, well, that's fine because I plan to borrow a lot, so I'm going to kind of get over here. Now, I'll remind you about one of the best concepts that Nelson Nash talks about in the original book, The Infinite Banking Concept, Becoming Your Own Banker, or not necessarily in that order, Becoming Your Own Banker, The Infinite Banking Concept, was the honest banker. And he's very, very stern about, making sure that you're kind of paying your policy back with interest that you would be if you took other financing. And he basically says, like, this is not like a get rich quick strategy. Well, if we follow that the honest banker theme a little bit further, if we follow that honest banker theme, like, why do you want to be getting over on the insurance company? And this is also something that's really confounding to me. It's like, if an agent is pitching you on how great non-direct recognition is, or like, you should do this company because they're non-direct recognition and their loan rate's really cheap, like 5%, and the dividends like 6% or whatever that looks like, then aren't you siphoning off the company? And so what's interesting is when you own whole life, you do become part owner in that company. And so out of the other side of their mouth, they'll be telling you that like, this is one of the biggest, safest, most solvent, financially solvent companies ever since the 1800s. And like, both of these things can't be true, right? Like, if they're giving below market loans and paying you above market dividends, and they're going to allow like everybody this agent knows to siphon off them, like again, honest banker, like they're going to go out of business, just like it says. So both of them can't be true. And I'll tell you which one is not true. The myth of non-direct recognition is not true, right? And we're going to discuss that here, like what's actually going on. But going back to being the honest banker, the direct recognition approach, like, is the truest way to be an honest banker when it comes to borrowing against policies. And not only you being kind of straight and fair with the company you're dealing with, but moreover, the company being straight and fair in dealing with you. Because what's interesting is if we look at the last time there was hyperinflation, in the early 80s, and even you can see this over the last couple of years, when loan rates, like outside loan rates, like cash value line of credit rates, mortgage rates, when they get kind of disconnected from the overall dividend rate or policy total return, it's usually in this inverted yield curve where things just spike very, very quickly, like they did in 2023, where short-term rates just got out of hand and out of control. And what happened in the 1980s, when that happened, like we think it was bad because it went from like whatever, 1 and 2 to 5 and 5 and change. When it went into the teens, what happened with Mass Mutual, because they've actually published their dividend rate alongside their adjustable loan rate, because all non-direct recognition policies have adjustable loan rates, is the loan rate was disconnected and a couple points higher than the dividend rate for the period of a few years. It was disconnected by over a point for at least 3 years. In my article, bankingtruths.com/direct, we actually show this example, and we're starting to see that happening now again. So like Lafayette Life is one of the most popular non-direct recognition companies, and they raised their loan rate. They used to give sweetheart loans at 5 for a long time. They did raise their dividend, but they never had one of the best performing dividends. And I want to say it's around 6. I don't know what it is off the top of my head right now, but we can look at it. Regardless, the loan rate is 7 and has been that since September, even when they were at the lower dividend. And so what happens is if you have these excessive policy loans, you're going to be negative amortization for, prolonged periods of time. And direct recognition is a nice built-in protection to hedge against that, because I believe that is the bigger risk coming up, not some minute effect on your dividend. Because let's face it, if you're borrowing against an infinite banking policy, the magic isn't in the policy. Like the magic is that the policy keeps compounding for you, even while you're using the money, whether it's compounding at this rate or this rate, or like that is not as consequential as what you're investing in. And so this hang up with, oh yeah, you don't want any effect on your dividend. Well, that may have been great in the low interest rate environment we had for the last decade and a half. Let's just say prior to 2022 and 2023. That was great. But even still, what's very, very interesting about that is if you were using a non-direct recognition loan, you were a sucker. Like that would have been stupid, because the loan rates never went below 5. I shouldn't say that. One America's loan rate, I think, went all the way down to 4.5. But their policy performance is so bad relative to the others. But like the Lafayette's, the Mass Mutuals, the Penns, they were all at 5. Penn is not non-direct rep, by the way. They're direct. Let's just talk about Mass Mutual, New York Life, Lafayette. Their loan rates never went below 5. Those are all non-direct recognition companies. Their loan rates never went below 5. But you could have gotten outside cash value line of credits, not for Lafayette because they weren't accepted by the turnkey lending programs. They are starting to get brought into these companies now, but they weren't then. But Mass and New York were. But if you could get loan rates at 3.5, 3, if you were a very high net worth client and you had really, really big loans, $1 million or more, sometimes just $500,000 or more, you were getting sub 3s. Why would you ever borrow from New York Life or Mass Mutual at 5 if Bancorp or Valley Bank, and now there's Incline, if they'll give you a loan at 3 or 3.5 or 2.75? Like you would just never do that, right? But again, this is kind of tied up in the myth. The myth, because of Nelson Nash's book, and it's really ironic because so many infinite banking practitioners just swear by it like it's the gospel. And when you read the book, what Nelson shows you in one of the chapters is that when you borrow, the policy actually performs better than if you don't borrow. Let me say that again. When you borrow against the policies that were illustrated in Nelson's book, which, by the way, were Guardian. He was a Guardian guy at the time, like I started there. And Guardian is a direct recognition company. You see where I'm going with this. When you borrow against the Guardian policy in his book, it ended up with more cash value than if you had never borrowed. And so what's happening is a lot of infinite banking practitioners are propagating this myth that, dude, you have to be getting that money in motion. You have to be borrowing against this policy if you really want it to cook and be seasoned. Well, that's only true with the direct recognition policy, and only true with the direct recognition policy when the loan rate is above the dividend rate, which indicates you're paying an above market rate, but at least the company is subsidizing you. There's a lot there, so let's just take a step back. If you have a non-direct recognition policy like New York Life, Mass Mutual, Lafayette Life, there is no benefit to borrowing against the policy unless they're offering the best rate. Period. Full stop. And anybody that says otherwise is a scammer. Let me just walk it back a little bit. I suppose if you need ultimate privacy, I suppose if, like with Lafayette, they still aren't accepted by a lot of turnkey cash value lines of credit. And so it may be the only place in town, like if that's where all your liquidity lives, that may be the only way to get at liquidity. But all things being equal, like if you don't really care about the privacy, a lot of these turnkey cash value line of credit programs, they will run a soft pull to get you approved on the program, but the loan is considered a cash secured loan. So it's not going to show up on your credit report, even if you're borrowing 95% cash loan to value, which is a concern for some people. Obviously, if you borrow too highly on any particular loan, it looks bad. Well, guess what? There's cash value lines of credit companies that don't report that to your credit. Now, right now in this environment, because of that inverted yield curve and spiking of prime, it's not the most efficient place to borrow. I think prime right now is 7 and change. I'm not going to look it up because I'm driving. Let's just say it's 7.25. Well, and let's say you can get a line at prime minus a half. Okay, so you're borrowing at 6.75. At that point, it actually does make sense to take the non-direct recognition policy loan, which is what Lafayette Life had until September. And so it's like, yeah, sure, I'll do that. But then all of a sudden they raise it to 7. Well, there's still a lot of Lafayette policyholders because of the bullshit that their agents told them about IBC and infinite banking, that they're better off borrowing against their policy at 7 than they are getting an outside line of credit at 6.75. And it's simply not true. Simply not true. Let's talk about the direct recognition. So if you borrow, let's just use the 5% example. If for a while, Penn Mutual's dividend was 5.75%, and their loan rate was 5%. And then when you borrowed against the policy, well, the 5% direct recognition dividend would the 5% direct recognition loan would pull down the dividend on that loan money. Just using the example, if you had $100,000 of cash value and you borrowed 70K of the cash value and 30 was unborrowed, you would get the 5.75 dividend for the 30K that's not borrowed, and the 70K that you borrowed, you would get a lower dividend. They would pull the dividend down. Now, this is where the cash value lines of credit, again, it didn't matter. It didn't matter whether your policy was direct or non-direct recognition, as long as the turnkey line of credit would accept your company. Like, sure, you just take the 3 or 3.5, even if it was 5. Now, it didn't matter whether you borrowed at 5 from a turnkey line of credit company or 5 from the policy loan, right? Other than maybe some convenience factors, other than maybe better kind of paper trailing to deduct interest. This is all discussion for another podcast. But I'm saying mathematically, there was no benefit. But with a direct recognition company, if you could borrow at 5 direct, and the dividend's 5.75, or you could borrow at 5 for the cash value line of credit, that's essentially, I call it synthetic non-direct, then it's actually better. But not so with all the non-direct recognition companies and policies. So hopefully that makes sense. What's happening now, though? Okay, so are you better off borrowing at, I believe Penn's loan is 5.3. Are you better off borrowing at 5.3 and taking a lower their dividend is now 6, taking a lower dividend? Or are you better off borrowing at 6.75? This is where doing the math is really going to help. Okay, run the loan, do the math, and you can actually figure that out. In my article, I have a great example of my wife's very first early Guardian policy. That direct recognition loan is pegged at 8. Now, Guardian, just so you know, nowadays, their loan rate is 6. Their loan rate is 6 in the early years of the policy. Sorry, I'm hot. I have to pull. I sweat when I talk loud. Got to put on some AC. But my old policy has an 8% loan rate. And so it was very, very easy for me to illustrate. It's a very small policy I set up. I was brand new. I didn't even set it up right. Didn't really even know about the infinite banking. It was like my first kind of week on the job. Got this policy on my wife. Kind of base only, a little bit of P-ways. And it shows that if she takes a loan for the car at the 8%, yes, her policy ended up with more money. But there's also a cost of money. And so I was able to do a calculation and figure out that it's essentially, if I can get a cash value line of credit or an outside loan at 6.25 or below, I was better off doing that and not taking the enhanced dividend. It's a balance. It's a system of debit and credits. And listen, I just want to go ahead and say this. You heard it here first. I've been saying this about direct recognition for years. I've also been saying the same thing about infinite banking. It's a series of debits and credits, people. It doesn't matter whether you borrow against the policy or not. Sometimes it does. Sometimes it's the best place to go, but it should be part of a greater system like my 4D banking system. You check out 4dbanking.com or bankytruths.com/intro. I have a great newer article about the intro to 4D banking. If you have stocks in a brokerage account, maybe you borrow against the stocks on a brokerage account because those are automatically deductible as investment interest, assuming you itemize. But if you do, you borrow against that. And if there's even getting close to a margin call, cool, then you borrow against your cash value and you make the margin account whole and true again. And that's one way of doing it. So at any rate, I hope this helps in terms of the myth of non-direct recognition, because again, both of these things can't be true. And it certainly shouldn't be the most important thing about your policies, but you're going to hear this. So again, I don't know if I got cut off, but it usually has to do when they're pushing these kind of ancillary features. It usually is meant to like kind of like look over here to mask the fact that the policy performance sucks. And like I've actually read on Infinite Banking Practitioner's website, like the policy doesn't matter. It's all about the process and the system. If they're saying that, it probably means that the policies they're selling suck. Full stop. Like it absolutely matters. It's a series of debits and credits, people. So why wouldn't you want the best credits possible? And yes, if a carrier has the ability to give you a below market rate loan, it's not fixed and locked in time. We're seeing that with Lafayette. Was great in August 2023, not so great in September. And now I think part of the reason they gave below market rates for so long, now they have to kind of true up, right? Again, there's no deals in insurance. This can't be the greatest company in the world and give you these sweetheart loans. Now they have to kind of true it up, right? And so now borrowers are paying the piper. And again, what I'm saying is the most important thing is performance. There's lots of other ways to get loans. And the most, like, to me, I put this in my article, it's the ultimate backstop. Direct recognition is the ultimate backstop. Because we can shop for loans on the outside so many different ways, you really want to control your cost to borrow. Like that is way more important. Again, if you're borrowing for things that are going to build wealth, that's where you're going to get your alpha. And yes, you don't want too much drag on your policy if you can help it. But what you want to know is you're going to be treated, if this is where you're going to concentrate all your liquidity, like how many Lafayette people use that single premium rider, dumped all their crap and dumped all their cash in there, borrowed against it, and now they're trapped at the 7% loan rate, especially since Lafayette doesn't offer, cash value lines of credit. Companies don't offer stuff to Lafayette. Some of them are starting to come around, but they weren't kind of one of the bigger mutual companies that was accepted on most of those platforms. And so those people are trapped. They're paying 7. What are you going to do? You're going to cash out all your PUAs down? Or are you just going to pay neg am for a little while? So I can't speak enough to the fact that that what you want to do is you want to, first of all, prioritize performance. And then you want to get educated about how direct recognition works so that you know you're always treated fairly. That means like, listen, sometimes loan rates are going to be below dividend rates like now. Sure, when you borrow using the policy loan, your policy will be hindered somewhat, but you're treated fairly. You're getting a sweetheart loan. Go make your money out there. What's better though is in times when things spike, like we're seeing now, at least you know you're going to get treated fairly on the other side. You're not going to go 2-3 years like Mass Mutual policyholders did in the early 1980s, where they were getting negative amortization. It actually wasn't amortized, but they're upside down on the loan rate versus the dividend crediting rate by 1 to 2 points for over a couple years. At least with direct recognition, you know that they're going to pull your dividend up and you're going to be treated fairly. So what am I recommending? I'm recommending to cut through the crap and to have your policies run performance, just no loans, just performance to performance. Then go ahead and do something where you actually see how the loans, like how it affects the policy. Go ahead, compare it to other non-direct recognition policies. See the delta, right? See what the effect is and make your decision from there. But ultimately, if everything's pretty close, I think you may want to end up like me. Again, I'm in the business. I have the choice amongst everything. When I did that first policy with Guardian, I didn't really understand about this. But when I took those Mass Mutual KIB policies in 2012, I absolutely knew what I was doing. And I was like, no, I'm not going to do the non-direct recognition. I'd rather know I can control my cost to borrow. So those policies have a 6% direct recognition loan rate. And guess what? Right now, the Mass Mutual's dividend 6.4. So I would have a little bit of neg am. It just so happens I have a lock from a prior cash value line of credit program at 5 that's going to be expiring in like a month. And I'm going to shop the rate and figure out what's best to do. But I was under market for so long. Like for years with those policies, I was borrowing at 2.75, 3.5, that like I'm so ahead of the game. So for the little times where there's an inverted yield curve and I'm a little bit upside down, I'm willing to take that risk, knowing that if there's a real big disconnect like we had in the 80s again, I'm going to be protected. Anyway, hope this helps. And we'll talk to you next time.